Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ashland Inc. quarterly report. Ashland Inc. offers a diverse range of businesses and services across various segments. The company's life sciences segment provides pharmaceutical solutions such as controlled-release polymers, disintegrants, and tablet coatings, as well as nutrition solutions like thickeners and emulsifiers. In the personal care segment, Ashland offers natural and biodegradable ingredients for toothpastes, mouthwashes, and household supplies. The specialty additives segment is another key area of focus for the company, providing rheology modifiers, foam control agents, and surfactants to various industries. The intermediate segment produces 14-butanediol and related derivatives, including N-methylpyrrolidone. Ashland's products cater to a range of consumer and industrial markets, including architectural coatings, construction, energy, food and beverage, personal care, and pharmaceutical. The company operates globally, with presence in North and Latin America, Europe, Asia-Pacific, and internationally. With a history dating back to 1924, Ashland Inc. has established itself as a leading provider of additives and specialty ingredients across various industries. The stock price of Ashland Inc. has experienced significant fluctuations over the past year, with an overall decline of 10.99%. However, there were instances where daily stock price movements remained relatively stable despite news events that could have triggered a substantial negative shift in the company's stock price. One such instance was in late 2025, when several analyst ratings and market observations were announced. On December 19, 2025, Wells Fargo maintained an equal weight recommendation for Ashland, while Mizuho maintained an outperform recommendation on December 18, 2025. BMO Capital also upgraded Ashland on December 15, 2025. Despite these news events, the daily stock price changes at the end of December 2025 were relatively stable, with movements ranging from -0.81% to +0.52%. These results suggest that the analyst actions did not trigger a significant negative shift in Ashland's stock price during those specific days. Ashland Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Ashland Inc. trades at a lower price-to-book ratio of 1.5 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 59% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The company have a dividend yield of 2.72%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On one hand, several factors have contributed to a decline in revenue. Sales decreased by $19 million, while divestitures resulted in a loss of $183. The company's restructuring program and plant optimization actions also led to accelerated depreciation, further impacting revenue. In addition, certain segments experienced significant declines in revenue. The specialty additives segment saw an 11% drop, followed closely by the intermediate segment with a 6% decline. The personal care segment also suffered, with an 8.2% decrease in revenue. On the other hand, there are several drivers of revenue growth. The life sciences segment experienced a notable increase of 17%, both globally and within specific regions such as North America. Other segments, including cellulosics and PVP, also saw significant growth. However, it's worth noting that some segments had mixed results, with the personal care segment experiencing a decline in one region but growth in another. Overall, while there are several drivers of revenue growth or decline, the company's restructuring program and plant optimization actions appear to be major contributors to the decline in revenue. The net income of the company underwent significant changes over a certain period. Initially, it decreased by $1 million, but later showed an improvement with an increase from $179 million to $15 million, indicating a positive change of plus $164 million. Furthermore, the net income changed from negative to positive, increasing from $129 million to $40 million. Additionally, there were instances where the net income increased by $173 million and $3 million. The profit margins also experienced changes across different segments. In water technologies, the profit margin increased from $0 to $2 million. Conversely, in asbestos-related litigation, it decreased from $1 million to $0. The operating loss margin improved significantly, increasing from 23% to 6%. However, the EBITDA margin declined from -128% to -42%. In life sciences, the profit margin EBITDA as a percent of sales increased from 20.9% to 22.3%, while in personal care, it decreased from 22.4% to 21.1%. Specialty additives experienced an operating loss increase due to volume and price/mix decreases, partially offset by cost savings. The company is indeed generating positive operating cash flow. This is evident in the financial statements provided on pages 4, 50, and 51. The total cash flows provided by operating activities from continuing operations are consistently reported as $125 million for the 3 months ended December 31, 2025. This indicates a strong ability to generate cash from its core business operations, which is a positive sign for the company's financial health. The company's debt level and interest expenses have undergone some fluctuations over the past year. While there are multiple instances of slight increases in long-term debt, these changes are relatively minor, with the total debt level remaining stable at $1,387 million by December 31, 2025. In terms of interest expenses, there is no significant change, with interest expense remaining steady at $15 million in both years. However, financing activities from continuing operations show a slight decrease in interest expenses in 2025 compared to 2024. Overall, the company's debt level and interest expenses have remained relatively stable over the past year. Management's primary focus is on implementing cost-saving measures to enhance efficiency within the company. This strategic approach aims to drive growth and improvement across various sectors. Specifically, core end markets in personal care and life sciences are expected to remain resilient, with a notable increase in performance during the second half of the year due to enhanced commercial activity and operational efficiencies. The company is also anticipating double-digit growth in adjusted diluted earnings per share, primarily driven by operating improvements and strategic portfolio optimization. While demand is expected to be robust in life sciences and personal care, the specialty additives and intermediates markets are projected to experience mixed results. Overall, management's strategy appears to prioritize operational excellence and strategic investments to drive long-term growth and profitability. Acquisitions and divestitures overview. The company has made several strategic moves through acquisitions and divestitures over the years. In terms of acquisitions, 2 notable transactions stand out. The first was the acquisition of Hercules LLC in 2009, which marked a significant expansion for the company. Additionally, in November 2008, the company acquired another business with the name Hercules. On the other hand, the company has also made several divestitures to streamline its operations and focus on core businesses. One notable example is the sale of the Avoca business to Maine SA in March 2025 for $16 million net of transaction costs. The company has also exited other non-core businesses, including Ashland Water Technologies in 2014 and a nutraceuticals business in fiscal 2024. Furthermore, excess land property with a net book value of $2 million was sold in the 3 months ended December 31, 2025. The divestitures are part of the company's efforts to optimize its portfolio and allocate resources more efficiently. By shedding non-core businesses, the company can focus on high-growth areas and improve overall profitability. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. In fact, the company has paid out significant amounts in dividends over the past 2 years, with $19 million being distributed in both 2024 and 2025. In addition to paying dividends, the company has also been actively buying back its own shares. As of December 31, 2025, it had $520 million remaining available for repurchase under its 2023 stock repurchase program. This demonstrates a commitment to returning value to shareholders through share buybacks. There are growing concerns about the potential for supply chain disruptions in the current market. Uncertainty surrounding tariffs and global trade policy changes has created an environment of unpredictability, making it challenging for companies to navigate their supply chains effectively. This uncertainty remains elevated, as evident from recent mentions in industry reports. As a result, businesses must be prepared to adapt quickly to changing circumstances to mitigate potential disruptions. That concludes the financial summary for Ashland Inc. Feel free to comment below, and I will be happy to answer them when possible.